Joining me now, Mervin Jebaraj, economist with the University of Arkansas Walton College of Business. He's also the director of the Center for Business and Economic Research. Good to have you with us as always, Mervin.
Thanks for having me on.
The Federal Reserve raised interest rates this past week. The question is, are these hikes in the interest rates, are they cooling inflation, which is their stated intent?
I think we can look at all the inflation indicators that we've gotten so far and say that the Federal Reserve has, mostly succeeded in their goal at cooling inflation. The most recent indicator that we have for June of this year indicates that inflation grew 3% from June of last year. So we sort of peaked in the summer of last year. That's when we were having those headline inflation numbers close to 10%, a little over, but today it's just 3% increase. So the Fed wants something between 2 and 2.5%. So I think they're well on the road to 2.5%. The question really that's left unanswered is how fast we get to 2.5%. I think the next few inflation readings, at least on a year-over-year basis, are going to have what we would like to call a 2% handle. So it's not going to be 2%, it's not going to be 2.5%, but it might be 2.9, 2.8, 2.7, getting ever so close to that Federal Reserve target without quite getting there this year. So from that perspective, maybe that's why the Federal Reserve has raised rates at least one more time. I think they've given us what we'd like to call a hawkish pause, which is to say that they're pausing raising rates for now. But they threaten to raise rates again if inflation isn't quite under control, or isn't, at least in my estimation, heading where it's going to head at the pace that it's heading. So I think overall, given the current composition of the Federal Reserve Open Market Committee that makes these decisions, I would guess that a good number of them are thinking that they will hit their inflation target, maybe not this year, but next year. There's certainly people on there that think that we should get there a lot faster, but that would come at the expense of economic growth.
And we might see interest rate cuts once they kind of hit that target inflation rate next year, too. At least that's some speculation. I could have asked you if interest rate hikes are cooling the economy overall, but I can tell you that they are not. We've got low unemployment. We've got still some very healthy consumer spending. The labor force participation rate is improving. And then we had a really strong GDP reading this past week for the second quarter. And it was a bit of a surprise as well for how strong it was. Talk about what's keeping this economy so strong.
So we're going to call this the Goldilocks economy, right? So we have inflation finally cooling quite significantly anyway. And the economy, in spite of these fast pace of interest rate increases, leaving us at somewhat historic highs of interest rates here. In spite of all of that, Federal Reserve action trying to cool the economy will not cool down, right? So I think we're seeing in the past week, we saw GDP print come at 2.4%, which was higher than expectations. And I think it was largely because of the strength of the domestic economy. So if you look at the components of GDP, what really pushed GDP up this quarter wasn't trade, wasn't imports or exports, it wasn't inventory adjustments from businesses, but really was driven by consumer spending, by business investment, and some government spending as well. So, consumers continue to be the bedrock of this economy. In spite of everything the Federal Reserve has done to try to cool the economy, consumers are still going out there and spending money. Now, consumers spend a little less money in the second quarter compared to the first quarter of this year, but that indicates that consumers are moving away from the high-priced durable goods, used cars and those types of activities, into a lot more service sector expenditures. The third quarter expenditures are not out yet, but I think you can see, at least from consumer spending, a lot more people are going out and doing things. In the past few weeks, we've seen a lot of consumers engaging in Barbenheimer, going and watching two movies at once. Having not been to a movie theater in several years, they're certainly spending a lot more time there. So I think, a good move from the durable sector expenditures to service sector expenditures is what's driving the economy right now. And I think that can provide long-term stable growth for the US economy. The second and very important factor here is business investment, and a lot of that has come in construction of new manufacturing facilities, and all of these construction of new manufacturing facilities are basically in facilities that are investing in electric vehicles, electric battery technology, chips manufacturing, all of those things that are driven by historic federal government expenditures through the bipartisan infrastructure law, through the CHIPS Act, through the Inflation Reduction Act, all of which had significant increases in federal government spending that boosted domestic manufacturing in these particular sectors. So we're not seeing the increase in manufacturing in those sectors. What we're seeing so far is companies going out and building new manufacturing facilities. So we'll see new chips, new batteries, new electric vehicles several years down the line. But what we're seeing, strong GDP growth from right now is that these companies are going out and building new factories, new manufacturing facilities across the country. And you can look at maps of this across the country. There's little splotches of new manufacturing facilities in metro areas across most of these states. So unlike previous manufacturing booms, these are not happening in rural areas. These are happening, not quite in the city of Dallas, but immediately outside the city of Dallas, not quite in the city of Austin, but immediately outside the city of Austin, not quite in Kansas City, but immediately outside the city of Kansas City. And you'll note that I haven't mentioned any Arkansas cities on there. It's because by and large, all of these investments in EVs and clean technologies have bypassed the state of Arkansas so far.
So the perennial question, will we or won't we have a recession?
So I think the last time we spoke, I said that I wasn't expecting a recession this year. That view has been confirmed by economists at the Federal Reserve as well. For the first time, they are no longer forecasting a recession anytime soon. So given the incredible pace of growth in the US economy, the historically low unemployment rates, continued increases in job growth, high labor force participation rates, high wage growth, which is what we're getting these high labor force participation rates, I don't see a recession anytime this year. And certainly the timeline for a possible recession is probably being pushed further into 2024 than most people had it in their forecast. So at this point, there's no good reason for us to be in a recession. The economy is doing great with inflation cooling.
And I even heard someone say maybe if we do have a recession, and not necessarily this year, but next year, to be a baby recession based on kind of the trend lines of where some things are going. So we'll see if that plays out or not. You can adopt that phrase "baby recession" from me if you want to for anything. So
that might sound like we're having fewer babies, which we kind
which
of
we
are.
are.
Yeah.
Well, we'll talk about labor and workforce some other time and babies. He's Mervin Jebaraj, economist with the University of Arkansas Walton College of Business. As always, thanks for your insight.
Thank you.